Joining me now is Katie Stockton, founder and managing partner of Fairlead Strategies. Katie, it seems like a tall order, but it had to climb a bit of a mountain to get here, no?
It did. Believe it or not, the stock is up 30% since the beginning of August, which is pretty remarkable, especially considering that the other mega caps have really faltered since then. Nvidia, by comparison, is up only 4%. So it's a really big up move from Apple, big outperformance. It's differentiated itself positively and now has this breakout pending confirmation. We always wait for confirmation because there are these whipsaws all the time on the charts. So we want to make sure it not only gets above a level, which is 260 as final resistance, but stays there for a week or two to confirm that breakout.
Now, why is this rally going to have such trouble lasting the week?
Well, we don't know, honestly, but when we look from a top-down perspective, it does look a little bit fragile to us, and that's based in part on market breadth. We've seen a real pullback in market breadth, and of course, we have seen a downtick in momentum. A lot of the 20-day moving averages are rolling over, and we were using those as one of our primary risk metrics. We've seen a breakout in the VIX as well. So for the S&P 500 below its 50-day moving average, we would expect risk to increase. And that's really not that far away. So we're a little, sort of suspicious of the sustainability of the uptrend at this stage without a consolidation phase. And we are seeing some macro shifts, of course, as well. Gold and silver are down very sharply right now, and they've been positively correlated to the S&P 500, doing very well, acting very much like risk assets.
What's been negatively correlated that perhaps investors should start paying closer attention to if all these levels don't hold?
Well, when you look at the sector relative strength, that's where you see the negative correlation. So anything that isn't technology, for the most part, has done very, very poorly relative to the broader market. And that's, of course, driven in part by the mega caps, and you could expand that to growth versus value. So any of the relatively oversold sectors or segments of the market should do better. That would include things like consumer staples, real estate or REITs, which are actually starting to perk up a little bit here in absolute terms as well. So that's where we're seeing it. But in reality, when you do see consolidation from a top-down perspective, very few stocks are immune to that. So even though the relative performance should be pretty good from the likes of consumer staples and healthcare, areas that have underperformed, it doesn't necessarily mean that these stocks are running away from us.
Did you take anything away from looking at the charts on the regional bank recovery?
Well, it's not enough to fix the damage that's been done. If you look at the KRE ETF, it has an overbought downturn and a pretty significant loss of intermediate term momentum. So the relative performance there has really suffered. We are currently underweight in our near-term recommendation for banks in particular, and that's just simply because the ratios have been trending lower. So we'd wait to see some signs of downside exhaustion there that are more meaningful. And for us, that comes in terms of sort of support discovery, oversold upturns, things of that nature.